Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Technology is creating opportunities in the commercial real estate industry at an increasingly rapid pace. Technology-fueled innovations are enabling those forward-thinking firms to reduce back-office costs and risk, raise equity faster, and increase asset performance so that they can focus more time on activities that drive revenue. Today, IMS is the most widely adopted investor management software for commercial real estate firms. Visit us at investormanagementservices.com.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Omar Khan. Thanks for being on the show, Omar.
Hey, it's a pleasure to be back here again. Thank you, Whitney.
Yeah, as the listener, you know that we've had Omar on numerous times because he's an expert in this field, in this business, in syndication. He's got lots of experience, and he's provided just tons of great value and content to all of us. I know I've learned a lot from him. And but today, we wanted to really dive into analyzing a deal. How do we analyze a deal without actually opening an Excel sheet, or how do we, limit all these deals that are coming in? How do we increase the deal flow? But then how do we know that we're spending our time on the right deals, analyzing the right ones? So, Omar, give us a little tidbit about your background and just how you got in the syndication, and then let's get right into how to analyze that deal.
Guys, I've been in finance for over 10, 12 years now. Did a lot of asset management across real estate and commodities. Did over $3.7 billion of capital financing and M&A transactions. And this is a topic that's very close to my heart. What we're going to talk about today, we run large multifamily syndications, is because you've got to cut through the noise. There are so many deals out there that you got to really figure out which ones are you going to chase and which ones you're going to pass on. And there is no way, no chance in hell that you can literally analyze every single deal that comes across your desk. In fact, you shouldn't even be doing that, because if you're doing that, either you have a lot of time, you have no life, and you're kind of a boring person, I guess.
So let's back up and just spend a couple of minutes on how to increase our deal flow. I hear people say all the time, I can't find any deals, or I can't get brokers to send me deals. How do we increase our deal flow? We'll touch on that, and then we'll go right into knowing which ones we want to analyze.
Oh, yeah. So, guys, first of all, what you got to do is you got to do your homework. You got to realize that a lot of people out there, they want to help you, okay? They want to do business with you. The reason why they want to do business is because that's how they make money. If you make money, they make money. Everybody wants to help each other out, okay? So, number one, you got to keep that in mind. Number two, what you got to know is that if you're talking to a broker, you've got to realize the broker is a salesperson. Okay, if they don't make a sale, they don't get to put food on the table for their family. Their kids don't get to go to college. Their wife, they can't take their wife out for a vacation. Okay, so they're going to have to allocate their time to people who they think are not tire kickers. And what is a tire kicker? A tire kicker is a person who's just going to waste the guy's time. He's going to kick tires around and never do anything. Okay, brokers can't do that. Okay, they just can't. So this is why when you're prepared, when you've done your research, and when you have, you come with a game plan, even if you're new to the game, brokers immediately start taking you seriously. Like we talked about in the earlier email, let's assume you've done your research, kind of a rough idea what you're looking for. You've developed your investment criteria. Literally, this is a template to write to a broker. Hello, Mr. Broker. We are actively expanding into your market. Our track record is XYZ. Don't write anything after. Just write investment criteria, bold and underlined investment criteria. Then write 4 points below that. So typically 4 or 5 points below that. Typically in our example, it's value add DC multifamily asset, 100 to 200 units minimum, $15 to $20 million minimum, deal size obviously, 1975 plus with pitched roofs, 10 to 15% below market rents. Website, what's a good time for us to talk? That's it, guys. Literally, that's a template. Don't write anything else. Don't try to talk about how interested you are in real estate and how it's been your dream. Nobody gives a shit. Literally, you do that, 9 times out of 10, the broker is going to get back to you.
I appreciate you laying that out. That's awesome. Tell me, you mentioned putting your track record on there. What if I don't have much of a track record?
Well, either you find people with a track record, which is, by the way, the easiest thing to do. You're gonna save yourself a lot of hassle. Okay. Or I guess you grind your gears and you just play the numbers game then. But I'm going to tell you, if you're trying to get anything over like a 5, 10, 20 unit deal, it's kind of weird. If you don't have a track record, how do you develop a track record, right? It's kind of this weird circular reference. But this is where you try to latch on to people who are either more experienced, who can bring their credibility, or they can refer you. I'll give you an example. My brother-in-law works in Facebook in San Francisco, right? He's got lots of rich tech investors, friends. They may have made a lot of money. They're not real estate investors, but they're pretty smart people. They made a lot of money, right? Because that's kind of a prerequisite if you want to play in these industries, or you need to have access to money or some version of that. So these are smart people. Now, if they're going to a market like Florida or Texas where we are, and, they reach out to me because, we know each other, and they say, hey, can you make a referral to a broker? And I know this person's smart. They're not real estate investors, but I know these are smart people. So they don't have a track record. I can still make a referral to my broker and say, hey, I know Mark out of, San Francisco. He doesn't have the experience, but he's got the money. He's got something. Smart guy. Talk to him. That's one way. Send somebody. Then the same Mark at one other stage has said, hey, why don't I work with you? You've got a track record, right? Why don't I bring in some capital? I make some connections for you, in terms of raising capital. I sign off on some of your loans, but then we get to work together. That's how Mark develops his track record. Or thirdly, what you can do, which I always recommend people to do, is choose to be born into a rich family. If you choose that, most of your problems go away.
So tell me, so now we've sent that email, we've developed those relationships with those brokers, and they're starting to send us deals. Let's go into how do we know which ones we want to analyze? How do we instead of just spending so much time on so many different properties that are being sent to us, really help us narrow that focus down?
All right, so I'm glad you asked, because we actually wrote a big long piece on our website basically on how to underwrite deals without actually underwriting deals, right? Guys, this is what I'm saying. Develop your investment criteria. Take an extra week. Think about what you can do. Think about what's possible. Develop that investment criteria like we developed, right? Now what happens is, if you say, let's assume I want to be in Dallas, 100 to 200 unit deals, value at BC, $10 to $20 million, 1975 plus, pitch roofs 10 to 15% below market rates, right? Then no matter what deal somebody tells you, no matter what deal somebody sends you. And by the way, the brokers initially, because you're not on their preferred customer list, right? Till you don't do a few deals with them, they are going to test you. They are going to send you deals that either don't fit your investment criteria, they couldn't find any other buyers, so you're the sucker at the table. They're just going to keep throwing it to you. So be polite, but get back to the brokers. Tell them, thank you for sending this. I really appreciate it. But we are looking for value add BC, 100, 200 units, $15, $20 million, and all that jazz that we talked about. And you have to keep repeating your message over and over and over again. When you keep repeating your message over and over again, and you don't have to do it 10 times, you do it probably 2 times, right? The broker gets the message. The broker understands that you're not a newbie, because you know what newbies do? They say, I just want to buy a multifamily asset or property. Well, what does that mean? It could be a 1,000-unit multifamily. It could be 2 units. It could be a duplex. What is it? So the more granular you are, it's a saying in banking, right? Specificity gets funding. So the more specific you are, and then you've got to hold on to being specific. So you can't be 100, 200 units multifamily one day, self-storage the other day, mobile home parks the third day. Then nobody's going to take you seriously, right? So if you keep saying these things, brokers start taking you seriously. Then they start sending you the deals. Now comes the fun part.
So give us so you've done that. You've talked to the broker, you've narrowed that down. You've narrowed it down to, how many properties would that be? On average, what kind of deal flow should we strive to get? How many deals a week are you looking at?
So for instance, in our business, even though we've established really good relationships with brokers, on average, brokers are sending us anywhere between 20 to 40 deals a week. Okay. There's no way I'm going to analyze and underwrite, or my team's analyze and underwriting to, 20 to 40 deals a week. You know what the filtering process is? Very simple. We know what our investment criteria is. So as soon as something, and guys, it's really tempting to either stretch yourself a little forward or to kind of say, look, I want to do 100 units, but I guess I'll take this 80 units, right? Don't do it. Don't fall for this trap. It's really tempting. Don't do it. So first of all, whenever we get these deals, and we still, even after our track record, we still have to keep reminding brokers, because again, you can't fault brokers. They're in the business of sales. Okay. Somebody sends us a deal. It's 85 units. We say, thank you, Mr. Broker. Really appreciate you sending this. We just literally just copy paste your investment criteria. Okay. Don't try to reinvent the wheel here. Okay. Copy paste your investment criteria. That eliminates 50% of the deals right off the bat. So you didn't even have to do anything. 50% of the work you don't even have to do. Then what do? Right? For instance, in our particular case, we've done a lot of market research. Part of the market research means that we've developed maps. Now you can use paid subscriptions, paid industry databases and all, or you could also be really smart and cheap, which is what we did starting out. We went to Google Maps. Literally, we created a custom map for each city. On each of these maps, we put stuff like path of progress. Now, what's path of progress? For us, it means yuppie stuff like, Starbucks, Costco, Trader Joe's, that sort of stuff. Then we put another, layer called schools. Any school that's rated above 5, 5 out of 10. Then what we do is every single time we talk to some of our investors, local people we know in the market, they tell us what are the good areas, what are the bad areas. Every single time we hear it, I'm telling you, initially it sounds like a lot of work, but it's not. We literally put it on the map under a heading called good areas. We list all these places. Then you can see it on the map. It populates, right? Under the heading called bad areas, we list all of these things down. You do this for a month. You know what happens? Now a broker's going to call you. Or send you an email, whatever. Tells you a deal. Hey, I've got this fantastic deal. And let's assume it even fits your investment criteria, right? You've done your market research, so your map is pretty good. Now you plonk it on your map. Immediately you'll start realizing, hey, is this in a good area? Is this in a bad area? Is this in the path of progress? Does it have good schools around it? Right? Now let's assume it's in a bad area. Lots of crime. You've checked it multiple times. So even if it fits your investment criteria, you're going to pass on that. You're going to say, hey, I know it fits my investment criteria, but the demographics aren't really good in this area, and the crime is a problem. The level of crime in this area is a problem for us. We're going to pass on the deal. That eliminates another 10 to 20% of the deals, right? So any of these deals, and now you're at 60 to 70% of deals, and you really didn't have to move your ass. You didn't have to do anything, right? But you're streamlining work. You have to streamline. You have to put processes in place. You're done with that. Now let's assume this is in a good area. So now you're going to see how good is this area, right? Is this a slam dunk, or is it a nice but not too nice area, right? That kind of determines how deep into the underwriting process you're going to go. Now, if this is in a slam dunk area, you're like, I've done my research. This is it. Find something, pounce on this, right? Now, let's assume you don't find it in that area. You find it in an area which is good, not too bad. You lose some preliminary underwriting, whatever, half an hour maximum. Either you'll do it, your team will do it, your analyst will do it, right? You'll kind of get a rough idea. As soon as you've gotten that rough idea, don't go deeper. Forget about it. Don't do that. Call up the broker. Be like, very interested in the deal. Let's talk. And I'm telling you, either that afternoon or the next day in the morning, the broker is going to set up a meeting with you. Now, you're going to come to this meeting slightly prepared because you kind of did light underwriting, right? And you're going to be like, hey, walk me through the story. Why does the seller want to sell? Now, sometimes it might be, hey, the seller's owned this building for 20 years. They just want to cash out. That's a pretty good reason. You're getting started. And trust me, guys, 90% of the time, you're not going to know the real reason, but you're starting a conversation, right? Then you're going to talk to the client and figure out, okay, what's the story here? Now, the story could be, as an example, the seller has implemented their entire value add program. So now, they're done with all the forced appreciation. They want to sell it off. And let's assume you're in the value add game. So you're like, okay, Mr. Broker, that's really good. We're in the value add game. We're going to pass on this. So you passed on this. So that's another 5-10% of the transaction. But let's assume the existing owner hasn't done a value add program. You'd be like, okay, that's very interesting. How much is the rent premium on this? The renovated rent premium. If I rehab these things, I bring them up to market, what is it going to be? Let's assume the broker says $150. Now, whenever the broker says $150, you always have to do 50% of that. Okay? Just say. So if the broker says $150, let's assume the broker says $200, you say, okay, 50%, $100. This is what I'm really actually going to get, right? Because the $200 is just marketing, right? I'm going to get $100. Let's assume your ROI criteria that we talked about in an earlier episode was 20%. So now if I get $100 more per month with a renovated unit, so I'll get $1,200 a year, right? Extra rent. The maximum I should be putting into this property, this particular unit, should be $6,000. Not a cent more, hopefully a lot of dollars less, but not a cent more, right? Now you kind of have a rough idea. And you figured all of this stuff out within the first 10 minutes of having this conversation. Now, if all of these things are pointing in the right direction, you tell the broker, look, I'm very interested. When are the calls for offer? Calls for offer is, what's the last date that you want to submit your LOI? That's the broker says it's in 3 weeks' time. You say, okay, this is great. When can we do a property tour? And I'm telling you, the broker wants to sell this because this is in their business. They'll be like, heck, when are you available to do a property tour? So then you hash out a time, you set up a property tour. Before you go on that property tour, you have a property inspector with you. They're going to do a walk and talk, right? They're not going to give you a detailed quote there because you haven't really started the process, but have that person with you. So when you walk through some of the units, because you won't be able to walk through all the units, not all the time before due diligence, right? They can kind of give you an idea. They can tell you, hey, there is structural damage in the building. And let's assume you don't have that specialty. So you're going to pass on this, right? But if it doesn't have structural damage, the building looks okay, the property inspector is going to look around and be like, yeah, I got to think you can put like $5,000 to $5,500 per unit into this thing. Now you're getting all these points. So you see how we started off with, say, 100 deals, but we didn't do a lot of work. And we filtered at least 70 to 80% of the deals out of the way without even underwriting anything substantial.
Who is Vinnie Smile Chopra? Came to the U.S. from India with $7 in his pocket, and today he has created a portfolio of over $200 million in commercial real estate. He's a CEO of 5 companies, acquiring and managing diverse multifamily portfolio of 3,500 units, and his team self-manage all the assets. Vinnie has walked the walk with over 26 successful syndications during multiple economic cycles, including downturns over 12 years. He has built a very extensive educational academy to teach and mentor investors. Vinnie, tell us about this Multifamily Syndication Academy.
Thank you, Whitney. Thank you so much. I'm really proud to really talk to everybody about this extensive multifamily academy that teaches new and sophisticated investors how to use other people's money through syndications. That has been my world, to buy apartments from 50 units to 500 units, and how to select emerging markets, how to do deal analyzing, investor education, other people money, syndication blueprints. Everything I have learned, I teach in this academy, and over 500 lectures, and also how to manage the assets also, and along with lots of great templates and PowerPoints, everything. And I personally also mastermind coach all my students every Wednesday. So to reach me, Whitney, all the students have to, or investors have to, just text the word learn, 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 to 474747, or call my team at 925-766-3518.
Nice. So you mentioned, before you really went to see the property, you'd already done that light underwriting.
Yeah.
So explain that a little bit. What did you do when you say light underwriting?
Well, light underwriting, what I'm saying is, when I get a T12, I'm seeing across all the major line items, is there something standing out? So let's assume, your bad debt. I'm just making up an example here, right? Your bad debt every month is, say, $500. But in the month of July, it was $10,000. Well, that kind of stands out, right? Why was it $10,000? You're going to ask them. Or, for instance, you saying that, rental revenue every month was, say, $10,000, but 3 months before this, the 3 months preceding this T12, suddenly rental income jumps to $30,000. Now, what's the reason there? A lot of times the reason is because the owner is preparing to sell the property. The owner is going to start jamming people into all the apartments that they can get just to kind of, raise the rental income and the NOI by brute force, right? So you kind of know these things. When you ask this question to a broker, the broker obviously is not going to say, oh, ha, you caught me. But, now the broker knows you're a smarter person. You're not some newbie off the street. Very different conversation. And then when you collect all and look, guys, no information in it of itself is going to be groundbreaking, okay? But you're collecting small little nuggets of information along the way. And when you collect all these small little nuggets of information along the way, it kind of gives you an idea. You look at the operating expense ratio.
it's running at, say, 60% operating expense. I'm making up a number here, but you know, because you've done your research, you've talked to people in the market, that assets of this size should be running at 50% operating expense ratio, right? Right off the top, you know that you can come in and quickly get a lot of low-hanging fruit off the table. So these are things, again, you're not trying to do a detailed model. You're not trying to, recreate the wheel here. You're just trying to, get the maximum value for your time before you actually make a time commitment to then underwrite, pencil all the thing, and do all of that kind of stuff.
Could you tell us how to calculate that operating expense ratio? I know it seems simple to some, but it may not be to others.
So the operating expense ratio essentially is, how this happens is that you take your operating expenses, right? So a lot of times you have to normalize your operating expenses. What does normalizing mean? Normalizing basically means that basically all one-time expenditures, you try to get away. You say, okay, if this is one time, I'm not including it because this is not part of regular operations. But let's assume you haven't even done that. Essentially what you're going to do is you're going to take all your operating expenses, you're going to divide them by your gross operating income to basically find out how much of your income goes to expenses. And it's a fancy way of saying how efficiently are you running your business, right? Now, the higher the operating expense ratio, the worse you are running the business. The lower the operating expense ratio, the more efficient you are in running your business. But there's always an average for each market, each product type, right? So mostly if the average is, say, 50% and somebody's running it at 20%, well, that means they're not including a lot of costs, which, I mean, you'll have to include those costs. They don't have to include those costs. They can do whatever they like. It's a free country, right? But now you know that that person isn't providing you the full picture. Usually how it happens is, a lot of times, folks who self-manage their properties don't include property management costs. But you have to include property management costs. So their operating expense ratio might be, say, 40%, whereas the average is 50%. So just because it's a lower number doesn't mean it's better. It could also mean that they just didn't include any costs.
So now, let's get into, I guess, we talked about the light underwriting. Let's go into the heavy underwriting, you could say. So you've been to the property, you've confirmed all these numbers. Where do we start? Where do we go from there to really get into the nitty gritty of pursuing this deal?
Well, yeah. So then you really have to start sharpening your pencil. So what then you're going to start looking at is, what is the rent growth forecast, number one, for my market, right? Or the sub-market that I'm in, and a lot of times it ranges between 2 to 6%. Sometimes it's 2, sometimes it's 4, 6, depending on whatever the outlook is, right? So you're going to have to take a bet on that. How do you find it out? You go to a lot of industry databases, you talk to brokers, you talk to property managers, you talk to other investors. But at the end of the day, guys, like a lot of other things in life, it's kind of a crapshoot, okay? So you kind of have to be conservative, but you can't be too conservative because then you'll never get awarded a deal. So it's like a tightrope, and you learn a lot of these things with experience, okay? Number one, then you're going to figure out how much renovated rent premium can I get. So if you were to renovate units, right? So if we're in the value add space, right? So if you come in and, we talked earlier, you're going to get $100 worth of renovated rent. And you talk to your property inspector, you've talked to other people, they say, yeah, $5,500, $6,000 per unit is fine. Now that's $100 on average. You can get a lot more granular than that. Then you're going to have to start looking at your operating expenses. Just because somebody else is running a property at a very low or very high expenses, depending on where you are, doesn't mean you have to run it at that level. You have to see what is going to be the average operating expenses I'm going to incur by line item: advertising, payroll, general and administrative unit, repairs, contract services, turnover, taxes, utilities, all of that kind of stuff. You're going to have to start looking at that. And then you're going to look at, what are my additional income? So if I come in or we have these properties, I'm make them look really nice and pretty, people are paying me more money, then can I implement services like valet trash, carports, reserve parking, self-storage facilities, dog yards? Can I do all of these things? And when you do all of these things, are you getting extra money for these facilities? Because if you're not getting extra money, don't do it. Don't throw your money into a money pit. Don't do that, right? You're going to start looking at these things. Once you start looking at these things, you're going to develop a 5 to 8 year pro forma. How are you going to develop it? You're going to develop it not on an annual basis. You're going to develop it on a monthly basis, because the whole deal with what we see all the time with newbie investors coming in is they look at the annual numbers. But the problem is, in value add projects, is if you don't look at the monthly numbers, you might run out of cash in the middle of the project. And unless you have a rich uncle or really, 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 really understanding equity investors who don't get annoyed at you, your business isn't going anywhere. You'll be dead in the water. So develop your monthly numbers. Don't look at annuals till you're done. Annuals are just a byproduct. So then you're going to develop a pro forma forecast of your income statement 5 or 6 or 8 years, however long you want, into the future. Then once you get to a future state, let's assume you say at the end of 5 years, I'm going to exit out of a property, right? I'm going to sell it. I'm going to take all this money. I'm going to return all the money back to my investors. I'm going to keep some for myself as per our agreement. And then we're going to go our own way. So on the exit, what are you going to do? You're going to take your net operating income, because you know the cap rate, right? That's how we value properties. Cap rate is net operating income divided by the value of the property. So in this particular case, if we, I'm assuming everybody went to 5th grade, took 5th grade math. Now we know net operating income divided by cap rate is equal to value of the property. So you're going to see the last month's worth of, say, net operating income. You're going to divide it by the cap rate that you feel is going to be appropriate to come up with the exit value. Like, what is the value I'm going to forecast and I'm going to sell this off at? And then once you have all this information, you're going to pay off your loan, you're going to get the money, you're going to distribute it out to your equity investors. Everybody's a happy camper.
Great information, Omar. So, that for that newbie investor, now that he's done this, or, what else does he need to know to make sure he's underwriting properly before we have to go?
I think what they need to know more than anything else is, guys, that a lot of times people get very stuck in the weeds in their spreadsheets, right? And by the way, look, I shouldn't be saying this. I'm guilty of this as well. A lot of times, guys, I keep saying this over and over again, there is no substitute to physically going to the property, physically touring the properties around it, looking at the neighborhood, doing the research, talking to people. Because a lot of times things can look really good on paper, but in reality, they can be really ugly. So it pays to do your research. It's really good to underwrite all these properties. It's very important to learn all of these things. And if you don't know it, I would suggest that you partner with people who can either teach you this thing or hold your hand or, be a partner in that deal with you. But a lot of times we have to step away from the spreadsheet. You've got to look around physically, not on the internet, physically. You have to physically go to the market and really understand, learn to live and breathe the market. Once you understand that stuff, you will start seeing your underwriting improving, your asset management improving, all of these things, and we're going to start improving.
So, switching from the newbie investor that's just learning to underwrite deals and making sure he's doing it properly to, let's say I'm a passive investor, and I'm looking at your deal. What do I need to know, or what do I need to focus on in your underwriting? When you send me an investment opportunity?
So good question. We get this all the time, by the way. So what you should be focusing on, a couple of big items right off the top. What are the rent growth forecast assumptions, right? They're the bulk of your drivers, okay? How aggressive or not aggressive are they? Because sometimes you could be too conservative, but sometimes you could be too aggressive. And by the way, both are not good options. And being too conservative also is not going to get you anywhere, because you'll never be in the race to win a deal. So I'll be honest with you, that also doesn't work. So there's a balance. Number one, you got to figure that out. Right? How do you do that? You're going to do some market research, not as much as say I would, because I'm in the business, but enough to understand what's going on. Number two, what are you going to do? You're going to start realizing, can a sponsor is the guy who's running the deal, can they provide you monthly forecasting numbers? Don't look at annual numbers, guys. Annual numbers, they hide a lot of detail. Don't do that. If your sponsor cannot provide you monthly numbers, run away. Don't look back. Okay, so then you're going to see how are they going to implement the value add program. Is it even reasonable? Let's assume your sponsor is buying a 600 unit deal, and they say they're going to upgrade all 600 units in 6 months, and their only track record is managing 20 unit properties. Well, it's kind of hard to do 100 units a month. So, kind of going to have that. Is it reasonable? Are all the assumptions reasonable? And then on the exit cap, which is, how you value your exit price, see what's going on. Usually what we recommend people is it should be anywhere between 50 to 200 basis points higher. Mostly these days it's between 50 and 80 basis points higher. So if you go in with a cap rate of say 6%, you should, on the exit, you should be valuing your property at say 6.5 or 7%, because you're being conservative. You're giving yourself margin of safety. So if you've done all of these things, and then your personal relationship with the sponsor and all of that, do you think they're credible, honest people, all of that, then that's a first step. You still don't invest. You still keep asking questions. You ask for referrals, you ask for questions, And they should be able to give you this information because, I mean, heck, they have to do this anyways to find out what the value of their property is. And once they do this, listen to the webinar. If anything, you're uncomfortable with anything, ask that question. It's your hard-earned money. You have worked very hard to save this money. You have all the right in the world to ask these questions. These aren't like stocks and bonds where if you don't like it, you can just sell it immediately. Take time. Take time to understand the sponsor, their track record, their underwriting the asset, and then invest when you're comfortable.
So you mentioned the term basis points, and I know to some that seems elementary, but to others it may not. I hear it all the time, but I find other guys who are just getting into the business who, they're like, what does that mean? And so could you just tell us what that is, and then we'll have to go.
So a basis point is basically, okay, it's a fancy way of saying 100 basis points is equal to 1%. Just remember that. Okay. So if somebody says 75 basis points, what it basically means is 0.75%. That's it. That's all you got to know about.
Omar, thank you so much for being on the show again. You're always a great guest, provide great content. And, I appreciate the listeners listening today and subscribing. And we would also appreciate, reviews and ratings, of course. But we would like for you to join our Facebook group so you can interact with guests like Omar, and you can ask him questions, and we can all learn this business together and communicate on there and network. And but anyway, thanks again, Omar. And we will talk to each of you tomorrow.
Perfect. Thank you very much, Whitney. It was a great pleasure once again.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.